welcome to the show. We're back together again. I'm done traveling for a little bit. Yeah, we're not together. This is as together as we're going to be for a while, probably. But I was on about a week and a half, almost 2 weeks of RV trip with my daughter before she heads off to high school and doesn't want to hang out with dad anymore. And if you guys watched the show last week, it was just Jerry, because I took all the podcast equipment with me, but RV parks don't have good Wi-Fi, and everything else went wrong. So we just we just decided to let Jerry record it. And so it would be interesting if you put in the comments, do you even care if I'm here? Like, can Jerry just get on the camera and talk to you guys? Because it would solve a lot of problems for us.
But it would not be as interesting, I guess.
Yeah, well, I mean, Jerry doesn't like to just sit there and stare at the camera and talk. He'd like to have somebody to talk to. But, man, it sure would be easier for me, though. I would just get the recording and, do the edit, whatever. No, it was not happening. It took me like 3 hours to upload that podcast up into the to YouTube's. And it's weird because I mean, this is just IT geek stuff, but most people think about the Wi-Fi and the internet and everything is it's fast as long as I can watch, Netflix or do whatever, right? And so that's download. And most people aren't uploading things. So the upload speeds at normal stuff is like not that fast. And you only learn that when you're doing this kind of stuff. And man, I was just sitting there. I was like, I mean, it gave me a chance to, finish a bottle of Gentleman Jack, but it was a long day.
It's 4th of July. That's,
Yeah. Well, it wasn't last weekend when we did this. So it just took me forever to get that uploaded. So, all right, guys, but we're back. Enough babbling on. What the heck happened last week? Because I don't even know. I was driving an RV across the country.
Yeah, I mean, it was obviously a holiday shortened trading week, right? And the market closed at 1:00 on Thursday, and we had Friday off. But it was a big first couple days, and it was a continuation of the rally that we've seen certainly since the April low. But then we had a little bit of a pause and then a big pop, not the week before last. So we'll get into it. This is going to be a kind of a broader perspective this week. We're going to look at a quarterly chart going way back, and then monthly charts, and then weekly charts at the end. So we'll look at what happened this week. I'm going to use a technical analysis tool called Andrew's Pitchfork for the quarterly chart, the really long quarterly chart. For some pretty interesting information we can pull out of that. Then the monthly candle charts, because we just closed up the first half of the trading year and the 6th month, right? So we just finished June, so we have a new monthly candle. And the bonus chart is going to be XLP divided by NYA, which is the ratio between consumer staples, which is what people need, as opposed to, for example, consumer discretionaries, which is what people want. So when the consumer staples stocks tend to rise faster than the overall market, which is the NYA. NYA is the New York Stock Exchange. So when staples is rising faster than the overall exchange, it's a sign of fear in the market. And it's a really, really valuable chart. And then we'll look at the TSP fund charts. So Monday, we get the Dallas Fed Manufacturing Index. So there are 12 Federal Reserve regions in the country. There's 24 Federal Reserve branch banks. They're not banks that we think of traditionally, but there are 24 Federal Reserve banks, 12 regions, and the Fed in each region is kind of responsible for banking and the economy in their region. And so the Dallas region, the manufacturing index was down 12.7 versus 12.3 last month, but it looks like this. So anything below zero is contraction. Anything above zero is expansion of the manufacturing side of the Dallas region. Okay, and the Dallas region is all of Texas, a little bit of Louisiana, and a little bit of New Mexico. So in that part of the country, it was expanding back here coming out of COVID in 2020 into 2021, and then turned negative in 2022, which we would expect. It stayed negative, right, all the way until late 2024, got back above that zero line, and then rolled right back over at the beginning of this year. And it's ticked up recently, but it's still well below that zero line. So that area of the country is not doing great in terms of manufacturing. We had a 3-month bond auction and a 6-month bond auction on Monday. The 3-month rate ticked up a little bit, right, to 4.23 versus 4.15 on the last auction. But the 6-month bond auction ticked down a little bit to 4.1 from 4.2. So what we don't want to see is those rates going up, because it means that the Fed is having to pay more for the money that's lending. So right now it's pretty stable. Then on Tuesday we get, as opposed to just the Dallas area, we get the whole U.S. manufacturing index, and that rose to 92.9 in June from 52. Sorry, 52.9 in June from 52 in May. And that chart looks a lot better, right? Anything below the 50 line is contracting. Anything above the 50 line is expanding. So the totality of the country in terms of manufacturing is expanding, and that's a good thing. But the Dallas region is still kind of lagging behind. Then also on Tuesday, we had JOLTS, so Job Opening Labor Turnover Survey. It's a really big number that the Fed looks at. It's new job openings. So it was 7.77 million this time versus 7.4 million last month. So that's good for the economy, right? There are more job openings available for people. That the number of job openings is going up. That's a good thing. The quits rate, right? That's another number within the JOLTS report. The quits rate went up a little bit to 3.29 million versus 3.21 million last month. So what that's saying is more people are quitting, which it might be an oxymoron, but the more people that quit, what it tells us is that there is confidence that they're going to be able to get another job, because you're not going to quit your job if you don't think you can get another one. So the more, if that quits number is trending up, that's actually a positive sign for the economy. So both of those are showing that we have a strengthening labor market, which is very counterintuitive to right now, because everybody's talking about layoffs, but the numbers are not showing that. Then on Wednesday, you got the 30-year mortgage rate fell a little bit to 6.79% from 6.88% last week, which is always a good thing, right? Mortgage rates come down a little bit. You get new applications rising 2.7% after they had already risen 1.1% last week. So kind of good news for the real estate market. We had a 5-year bond auction that closed at 3.879 versus over 4% on the last auction. So again, that's a good thing. Everybody's worried about rates going up and the Fed having to pay more to borrow money, but it's not happening. That's why it's really important to look at the actual numbers and not just listen to, the sound bites on CNN and CNBC. S&P was up 0.47% on Wednesday. Then on Thursday, you get non-farm payrolls, 147,000 versus 100,000 that were forecast. So a really big number on, again, new jobs created. And we had 144,000 last week. And the unemployment rate dropped to 4.1% from 4.2%. So the numbers are not indicating that the economy is rolling over. The jobs numbers are getting stronger. They're not getting weaker, which may, seem like an oxymoron, but that's what the numbers are. That's what they are. Initial jobless claims, 233,000 versus 237,000. And the forecast was for 240,000. So the economists thought that there were going to be more initial jobless claims, but they're not. There were actually fewer than last week. There were very strong employment numbers, and that had a lot to do with why the market popped this week. Then we closed at 1 o'clock on Thursday. The market was up 0.83%, and we're closed on Friday for 4th of July. Okay. So Andrew's pitchfork, this is a good one. It's a long-term perspective. It's certainly not going to help us out with, what should I on a daily basis, should I buy or sell, or reallocate between the TSP funds? But it's a really valuable tool. So Andrew's pitchfork, it's a technical indicator that uses 3 parallel lines to identify support and resistance levels, and also potential breakout and breakdown levels. But the best way to use it is it's basically a mean reversion technique. And so if you're looking at a chart of the S&P 500, we're going all the way back. This is the top of the market in 1929. Okay, it's a logarithmic chart. So you can see the prices on the side here. They don't go up in even increments. It's logarithmic, but it's a really good way to look at a long-term chart. So this is the bottom of the Great Depression. We got a 1, 2, 3, 4, 5 to an initial top. Then we have an A, B, C to an initial low. Okay, so if we use this decline, the vast majority of the move ever since then, ever since 1940 or so, all of this is basically in a channel. Okay, it's not random, and it starts with the length of that move down. And so when you apply the Andrew's pitchfork to it, that's what it looks like. So the tool gives you these lines. You put the top point here, the bottom point here, and this line you can move around. And what you want to do is pick the midpoint of the channel as it goes forward, and it tells you the midpoint. So as price goes up and down, it's going up and down along this red line. So the further it extends to the upside, the closer you are to a pullback. The further it extends to the downside, the more likely you're going to get support there and get a big rally out of it. Okay, so you're moving back and forth within that channel. So this is a really long-term chart. Each one of these ticks is a quarter. Okay, 3 months of price movement. So what happens is price runs up, hits that median line, rolls over, right? Doesn't get all the way to the bottom here, comes back up, oscillates through there, breaks through that median line, right? Comes up to the next and hits resistance there, gets support here. Okay, so the median line is a big support and resistance level, and then these 2 lines tell you that you're way overbought or way oversold, right? The 2000 tech bubble took us a little bit outside of the range. We were way overbought up here and due for a correction. That correction took us back down to the median line, right? And then we rallied up to 2007, hit resistance at that upper, this top of the range, that piece rolled over, broke below it, got support at the bottom of the range. Okay. So where are we right now? We still have room to move higher, right? If we were going to get to the top of this range, which has only happened one time in the last 100 and whatever years that we've gotten outside of that range or even close to the top. This is as close as we've gotten to the top of that range since the top of the tech bubble. Okay. So from that perspective, we're pretty far overbought, right? If price came down from where it is right now, which is the top of that arrow, if it came down just back to the median line, which it's going to, because it always comes back to the median line. It's not a matter of if, it's a matter of when. If it rolled over now and came back to that median line, it's about a 30% move to the downside. Okay. If it moved down to the bottom of this range, that will be a really good buying opportunity, right? Because whenever it gets to the bottom of the range, it gets support if this long-term trend is going to continue. But if it did get down to the bottom of the range, That's about a 56% move to the downside. Okay. So those are the long-term kind of numbers and perspective that we're looking at. We are at some of the highest levels that we've ever been, right? Usually this is the peak. This upper channel line is generally the peak, but we got above it here. And that was going into COVID. That was in 2019, 2020, going into COVID. We were pretty overbought at that time. Had the COVID correction, came back up, and we're getting pretty overbought again. So again, each one of these ticks is a quarter. So it could take a couple years to get up to the top of this, right? But we're getting there. And at some point, we're going to get a pretty significant correction. I'm certainly not saying it's happening tomorrow, but this is all long-term perspective. Okay. Monthly. So if we zoom in a little bit and look at the monthly candles, and we go back to the bottom here in 2009. So we have a 10-month moving average line in blue. Okay, that blue line is just the average closing price of every month for the past 10 months. And it plots along that line. So what you can see is once we get back above that 10-month moving average line, we tend to stay there for a while. There are long periods, right? Once we get above there, we have long periods where we tend to stay above that line. And so one of the models that if you're a subscriber to the site, one of the models that we have, we call it the long-term trend model. And we have an algorithm that shows when the trend has changed on a monthly basis. So it's a long-term trend. But this was, so I started this one back in 2007. This was on a long-term basis, the trigger for that model, right? And had you gotten out of the market when it triggered back then, you avoided virtually the entire decline from 2007 into the bottom in 2009, right? Once we got back above the line, it tended to stay, well, it did stay there for several months. We had a little bit of a correction here. You could call this a whipsaw. If you get out and in on a relatively short basis, they call it a whipsaw. It happens once in a while, but for the most part, you can see once we get back above that 10-month moving average line, it tends to stay there for a long time. Okay. And we just had a bit of a whipsaw here recently, right? But now we are back above that moving average line. And when you get a trigger like this, a bullish trigger on the long term, if you look at each of these green lines, every time we get a green line to the upside, you tend to have long periods, right, where the market's moving higher. And we just had another one. So with all the things going on in the world, the long-term trend has just started a new bull market. On a weekly and daily basis, there are certainly going to be ups and downs, but in the big scheme of things, we just started a new long-term uptrend. That's what the chart says. That's not what I'm saying. Okay. Bonus chart, XLP versus NYA. So this is a really useful one. Again, XLP is consumer staples. NYA is the New York Stock Exchange. It's the whole market. So if you're looking at the ratio chart, so when the ratio goes up, it means there's fear in the market, right? Investors are buying staples versus buying Teslas and things like that. And you can kind of see here, this was the peak. This peak was the bottom of the stock market in March of 2009. The peaks tend to correspond to stock market bottoms, and then the lows correspond to stock market tops. So if we superimpose the S&P 500 on top of that, so this is now the ratio chart, and this is the actual S&P 500. what happens generally is investors are anticipating the market rolling over. So you tend to get the ratio moving up before the market actually rolls over. And then as the ratio continues higher, then the market rolls over. So like, and this is a good case here in 2011. You have a bottom in the ratio, it starts to move up, but price is still moving up on the S&P, right? But it's anticipating this move down. And then the ratio continues higher until it peaks. It rolls over, stock market goes up. This was a good one right here. This bottom in the ratio, it starts to move higher, but the market is still moving higher, right? But eventually it is anticipating this rollover in the market into 2016, and the ratio keeps moving higher. So where we are right now, the ratio, the trend has been down. So when the ratio trend is down, the stock market is going up. Okay. Most recently, it's collapsing. I mean, it's going straight down, and there's no indication that we are in some kind of bottoming. Because if we had a pattern like this, if it started going sideways and the market continued higher, it would tell us, hey, a top in the market is imminent, because once this ticked back up, then the market would come down. But we're not seeing that. There's nothing here that indicates in the chart that the ratio should do anything other than keep going down, which means the stock market keeps going up. So super valuable. If you start watching XLP divided by NYA and you start to see it turn up, especially if the market keeps going up, a top is coming, but we're just not seeing that yet. Okay. And then we're down to the weekly, right? TSP fund charts on a weekly basis. It's all bullish, right? Once we got this gap up to that 20-week moving average line, that was risk on. Investors were piling in. We got that initial move up. We consolidated for a few weeks, and then last week had a big move, closed at new all-time highs, and then a follow through this week. And we still have room to the upside before relative strength gets overbought. There's nothing but bullish news on these charts. As much as the news is kind of frightening, honestly, the charts are not confirming that the market's going to roll over anytime soon. S fund, same thing. It was a huge breakout for the S fund last week. Broke above that downsloping trend line, and then another big move this week. The best thing for the S funds would be if rates came down, because S fund is like small to mid cap companies, and when rates come down, that helps them a lot more than it helps the C fund. So if rates come down, it's very possible that the S fund, it has outperformed the C fund for the past 2 weeks. And if rates come down, the S fund should get up to new all-time highs also, and very likely outperform the C fund. And again, a lot of room to the upside before we get overbought on relative strength. I fund keeps on going. I would really have liked to have seen some more deep correction on the I fund than this, at least getting back down to that 20-week moving average line, but we didn't get that. I fund is already overbought. So, I don't know. I would like to see a pullback in the I fund before I get into it personally, but certainly it is moving up and to the right. And then the F fund potentially breaking out here, right? It's hit a triple top. The F fund is really only valuable for us as a tool under certain market conditions. If there's a lot of fear in the market and the stock funds are falling, the F fund generally goes up. But if the F fund and the stock funds are both going up, you're going to get a much better rate of return on the stock funds than the F fund. So I really only look at the F fund. I mean, the chart is important to watch, but if they're both going up at the same time, then the stock funds are a way better place to be. And the G fund goes up and to the right. So we are coming into what is seasonally either a high or a low for the market. The middle of July tends to, almost always identifies either a top or a bottom in the market. So it either begins the summer corrective period, or we had like a spring correction, and the middle of July begins the rally kind of into the end of the year. We are obviously at a high point. And so on a short-term basis, at least, you should expect some kind of pullback going into middle of July into August, but the long-term trends are very clearly up.
Yeah, and it's all about perspective. Where are you at now, right? Where are you allocated now? We're talking TSP, right? And so I've seen a lot of chatter with folks, in the gov that are, feel like they're missing out with the I fund, right? And you don't want to get in because of FOMO, right? Fear of missing out.
Right.
So, if you're not in there, and this goes with any of the funds that are on their way up, particularly like Jerry showed in the iFund chart, it's way over, right? So you don't want to get in there. That's getting in at the high point. Does it go higher? Maybe, but you're risking a lot by getting any stock, ETF, TSP fund, getting in on that high part, right? So never let that kind of drive your decisions. I have seen people recently that are just like, okay, it's just going to keep going, so I'm going to get in. Okay, but you're risking a lot because it's going to pull back at some point, right? It has to. It doesn't always go up. So just keep that in mind. When you're doing this, never make decisions out of fear. That's the biggest thing. Fear and greed will kill you. What you need is discipline.
Yeah, we're certainly. We're at new highs on the S&P, and so there's a lot of money now coming in from the sidelines, and people are getting very greedy. You say you want to buy. Everybody always talks about you want to buy when there's blood in the street, right? You want to buy when everybody's fearful, and that's true. The other side of that is to sell when everybody's greedy, and
Right.
Nobody wants to do that.
Right, because you're greedy. You don't want to have fear or greed. That's for everybody else. All right, guys, if you have questions about anything in the podcast, just put them in the comment section wherever you found the video. If there's no comment section, you can always shoot us an email, support at growmytsp.com. If you send it to info, nobody's going to see it. Somebody will see it, but it won't be us. Anyway, support at growmytsp.com, and the support team will get it over to us if we can answer it. We love getting questions from folks. Sometimes it gives us topics to talk about here on the podcast. If you like the podcast, please share it with your friends, and hope you guys have a great week. We're going to do our best.
Absolutely. Right. Happy 4th.
Yeah. Well, is today the 4th? Yesterday was the 4th. Happy 4th weekend.
Yesterday was the 4th.
All right, guys. We're out of here.